Let's talk oil. Let's talk natural gas. Let's talk energy. I mean, boy, that has been a hot topic. If you look at the markets, you look at oil, having a huge run in the last 3 months. Natural gas is still the topic of conversation, really globally, actually, when you think of things. So we're very pleased to welcome back to the show Josef Schachter, Schachter Energy Report. But it's more than that. I mean, we've known Joseph on this show for 20, 25 years. First, he worked in industry, though. All his research was done for companies. He still, of course, does that, but decided a few years ago, actually, it's about off the top of my head, 6, 7 years ago, to do the Schachter Energy Report for individual investors, where he recommends, says hold, says buy, says all of these kinds of things. And I'm looking forward to hearing his perspective on a very hot energy market at this point. Joseph, thanks for finding time with us.
Oh, much my pleasure as always, Michael.
I also going to mention, I'll give some details later, but Joseph's got a monster conference coming up. It's one of a kind. It's for individual investors. He does lots for businesses and for people in that business, but this is for individual investors, and I'll tell you more about that in a few minutes. But first, Joseph, let's give the big overhead view. Are you bullish or bearish? I'm talking long term now. Are we still in a super sort of oil cycle, do you think?
Yeah, I think we've talked before that I believe we started in 2020 an energy super cycle. And there's been two before in my career. The one in 1974 to 1981 was when we saw Japan become the monster juggernaut economic power, cars, Panasonic, Sony's, all the things we bought from them. And they became at the margin, the big buyer of crude oil. And that was when we went also where OPEC was founded in 73, 74. And the price of oil went from $2 in 74 during the recession to $36 in 1981. And of course, then inflation went rampant and Volcker and the other central banks shut her down. The second cycle was 1999 to '08, which was when China opened up to capitalism on the business side under the communist umbrella. And they went from using less than 3 million barrels, producing to consuming about 15 million barrels right now, still producing about 4. So they're importing about 11 million barrels a day. And we've seen the price of crude during that cycle go from $10 all the way up to 147 at the top in the summer of 2008. The third cycle started in 2020. And of course, because of the COVID and all the rest of it, we were down, as you know, $6 was the posted price of the next one, but negative pricing because of the short selling going on in Britain by the hedge funds there. And we've gone already to $130 after Russia invaded Ukraine. I think we're in a pause a little bit here, but I think before the cycle is over, before the end of the decade, maybe into the next decade, I think we're going to see all-time highs. And this cycle is the renewable cycle. We need more lithium, copper, nickel, all the things to create the renewable world that we want: solars, electric vehicles, tidal, all the things that we want to create, low emission energy. And that's going to require a massive investment in Chile, Argentina, all around the world to bring those to us, which means those countries are going to use a lot of conventional crude oil and natural gas, and their quality of life. They want a better quality of life for the people working there. All of that is going to mean that while the OECD demand will come down because of more use of EVs and more renewables, demand in the non-OECD will take off and rise significantly. So right now, I think we're looking at 102 million barrels a day of consumption in 2023, but that number could be probably 108 to 110 by the end of this decade, but all of the growth coming from the emerging world that will be providing us the raw materials we need to improve the environment in the industrialized world.
Look, a couple of things there in what you're saying. It's interesting how, the need for all of those minerals that you mentioned, whether it's a rare earth, whether it's a lithium, copper, et cetera, all are going to require huge amounts of mining, huge mining machinery, fueled by fossil fuels, diesel or gas. And I just find it amazing that that's rarely acknowledged, even today, was never acknowledged going back just a couple of years ago, as a demand side. And I just think that's an important point that you're making, because we're not getting rid of this stuff quickly. If you want to do the renewable side, I mean, as you say, it enhances the demand right there for that.
Yeah, and in the meantime, the emissions that are going to be created in those other countries to create the new world that we want to go into are going to be substantial. And I think the thing that really people need to focus on is yes, there's going to be emission growth in these countries as they develop these raw materials that we need, but the goal has to be that we get rid of the worst of the emitters, and that is coal. And if India and China would take a very forceful approach to closing down their coal industry, coal fired utility industry, as we've done in North America, and as Europe is doing, except when they had the problem
Yes.
after the invasion, I think that that's going to be more helpful to meet the climate goals of 2035 than any other thing we do.
Yeah, the way that we have so much of the analysis, broadly speaking, has been so focused on domestics as opposed to failure to recognize the huge demand coming out of emerging markets, developing nations as they want to raise their standard of living. I mean, that's another monster component of the story that again gets ignored far too often.
Yeah, and I think as people realize the number of employees that are going to be needed in the mines and in the manufacturing, and a lot of the companies want not only to be producing the lithium, they want to upgrade it to the
Yes.
quality that's needed. So they're going to want those higher quality, higher value manufacturing jobs to stay in country. China, be it China being forced to do it in Argentina, Chile, wherever. That's going to be part of it so that the industrialization and the higher quality of life and higher value system in their economy is going to be something they're going to be pushing for, not just to be producers of the raw material and having the high quality and high paying jobs going elsewhere.
Let me come back to China for a second and link it to the prices we're seeing today, because I would think it's a fair statement to say the vast majority of analysts were sort of disappointed by the lack of recovery out of China, or demand coming out of China. The scenario that was pretty well accepted was when China lifts those lockdowns, look out, you're going to see demand pick up everywhere, and clearly it has not to the degree that people were expecting. And yet, what do we find? We find oil having this really strong run over the last, say, 3 months, to pick a time frame.
Yeah, China's demand has gone down. The imports in China are down over 2 million barrels a day in the month of July versus the month of June
Hmm.
because of the slowdown in the economy. But the key thing is OPEC originally said in June that they were going to cut back 1.2 million barrels in the months of July and August. And then the Saudis said, we're going to cut another million on top of it. So the Saudis have done that. They have cut back that number. But the other, countries like Iran and Iraq and others have increased their production, and so Saudi said, "Okay, we got to keep cutting back longer. One, we're going to keep it till the end of September." And then the announcement a week ago, which really popped oil by $10, on the upside, was that they were going to extend the cuts until the end of the year. And so that is where you're now seeing where IEA, the International Energy Agency, says we may have a shortage on some days of 3 million barrels a day
Yeah.
during Q4, during the winter of 2023-24. There's others like the EIA, the U.S. Energy Information Administration. They're saying that we will be balanced. And then there's others that are saying because of the big drop in China, problems in Britain and Germany, we may have a surplus building in the fourth quarter. So right now the dynamic is focused on the bullish side, i.e., there may be 3 million shortage, listening to the IEA and OPEC. But the reality is, people need to realize that the U.S. is self-sufficient in energy. They're not a real importer. Just taking the data from Wednesday of this week, domestic production in the states went up 100,000 to 12.9 million, and the U.S. production of natural gas, liquids, and renewables, which are a bigger part of going on there, was a total of 8.9. So we're looking in the U.S. of numbers where the U.S. is producing right now about 21 million barrels and 21.8 million barrels, and the consumption is 21. So the U.S. is self-sufficient. And we going back to the data of 2011, which is the farthest I could go back when I went back to the EIA data. U.S. crude production was 5.6 million barrels, and renewables were 4.25 for 9.89, but they were consuming 19.4. So they were net importing 9.5 million barrels a day. And the SPR at that time, the Strategic Petroleum Reserve, had 700 million, 73 days of imports. The U.S. right now has 126 days of net imports because they're only importing a very small amount. So when
Oh,
everybody talks about SPR, I think it's a boogeyman that's not really something that's valid, because SPRs were created to have the amount of fuel that was needed over 60 days of net imports in case there was a problem with the shipping industry or war or whatever. And the U.S. has more than enough, given the increase in shale production that's happened with the Permian and the Eagle Ford. And the fact that the U.S. is now producing 800,000 more a day than they were a year ago is quite a substantial, saying that these high prices and longer reach horizontal wells, more productivity from the fracking, and with the price of oil going up, tier 3 wells have now become tier 2 wells, tier 2 wells have become tier 1 wells. So
yeah.
companies have way more wells to drill, which means and even though the drilling rig count is down, the production in the U.S. will continue to go up. The EIA is projecting that from that 12.9 of this week, that the U.S. will average in 2024 13.2 million barrels a day of crude alone, which means they will potentially be an exporter to Europe if there's ever a problem again in Europe.
Um, is there a number where you think oil gets to and it creates demand destruction? Like people just say, I'm backing off. I'm not paying it. Like I find that easier to understand for me if it's gasoline. Once gasoline gets to a certain price, then people drive less. Is there a price for oil, or is that just a ballpark kind of thing?
Well, I think it's you've got to take into account also taxes, carbon
Yes.
taxes now. So in Alberta, we're paying $1.41 a liter. I think if we were $1.70, $1.80, that would probably tell people maybe I shouldn't drive so much, or maybe I'll go to the closest store rather than run to two or three. I think if you're over $2 a liter in BC, I think that will have some impact on the amount of
Yeah.
usage you'll have. And I think Ontario is probably pushing $2 right now.
Well, I'm just laughing. I figure you just put that in there to give a dig to everyone in BC who says, "What, under $2? Are you kidding me?" I think the last time yeah, you're right. Last time I saw, talking to friends, filling up, it's just under two, but we were above two out in British Columbia just a while ago. So yeah, thinking of the Alberta price at 140, 145 seems pretty sweet. But let me come also. Do you think the bullish case has now been absorbed in the price? And I'm only talking short term. I'm not disputing the long term super cycle. I'm just saying on a shorter term, are all the bullish factors dominating, but have they all been accounted for at this point? That's when you move 30% in about 3 months, they're already anticipating those bullish numbers.
Yeah, and there's one thing that I've shown at the World Outlook Financial Conference, and I put in our research, is something called the S&P Energy Bullish Percentage Index. And when we had the bottom in March, when we went bullish, and I was on your show,
Yeah.
and I said we were table pounding buying opportunity in the sector. We had 7 names on March 13th, 7 on March 15th. The price of crude was $65. Now we're at 90. I think we're getting a little overheated. The bullish percentage index in March went down to below 10%. It went to like 8%. We're now 96% bullish. And I'm getting phone calls from people asking me, what should I buy now, who wouldn't listen in March. So
Yeah.
to me, this is like a short term warning signal that we need a pause here. And we're suggesting to people, look, some stocks we recommended in March are up 50% from where they were in March. Maybe it's a little prudent to take some short term profits, build up some cash reserves, and wait for the next low risk buying opportunity. Historically, you get 2 to 3 buying opportunities a year. So we got 2 in March. I think we may see some tax loss selling in the general market that will pull energy down because it's a high beta sector. Maybe we get one more buying opportunity. But anytime we have a low risk buying opportunity where the bullish percentage is under 10%, my men there saying buy, 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 and we're coming up with ideas. If you're a conservative investor and you need yield and you want some capital gain, there's lots of ideas out there now. Even today, if you look at the pipelines and
Yeah.
infrastructure stocks, Enbridge and TC Energy and Pembina, they've been hit hard here. Enbridge the worst because of that financing that they just did for that major buy that they did for utilities in the States. You're looking at yields that are fabulous on these companies. Just to pull out the yields here for a second. TC Energy 7.7%, Enbridge 7.8%. Well, if you buy in at the right price and you get 5-10% capital gain potential for conservative investors, that's a home run.
Yeah, absolutely. To do with that, but you don't trade your core position. I'm just talking about investment approach. You keep your core position, and as you say, now you've had some big gains, especially in such a short time frame, relatively speaking. So you're not selling your core, but you might be creating some cash to take advantage later on.
Yeah, like taking 10 to 15% off, to being, because stocks are up 50, 60% on the ones that I did, and the one that I did. And so my view was take some profits and build up some cash reserves, all the dividend income that's coming
Yep.
in, put that in the cash reserves, and be waiting for the next low risk opportunity, and add to the names. So we were down to maybe, 4 or 5 names before March. We're sitting with owning 9 names right now personally on the energy space, and then other areas and other markets we have. My view is the maximum capacity for me is 12, and then build up the positions
Yes.
with greater amounts of capital. That's more than most investors would have. Most people may only have 2 to 4 names in energy between pipeline infrastructure, oil, service, etc., and clean tech. So to me, I'm a more of a barbell approach because I know the sector and I spend a lot of time on it. And what we do is when we put out a buy recommendation, we have to wait 5 days before Patty and I can buy it. And when we say sell, which we haven't said sell, but we said take some profits, the same thing, 5 days before we can trigger booking some gains. But to me, that's my comfort zone. And I think the sector has a long way to go. For example, let's use TC Energy. It closed at 48.57 on my last run, and pays a 372 dividend quarterly, 7.7%. And we have a target, 1 year target of 60, but a $90 target for the bull market peak. So if you buy it at the right price, that's $60 if it happens in the next 12 months is a pretty good return. And so that's the kind of thing that we're saying for conservative investors, more entrepreneurial names. If you take something like a Birchcliff, which has been a presenter at your conference
Yes.
for the last number of years, the stock was 842. It pays an 80-cent dividend, so you're getting a 9.5% yield, 20 cents a quarter. It's a fabulous yield. And we have a $15 1 year target because we think LNG Canada is going to approve Train 2, and we're going to see the Coastal Gas Pipeline come on, and that's going to cause a pickup in prices. And we have a $25 bull market peak price. So there's lots of upside right across the sector and all the names that we cover. And we're just saying, wait a little bit. Some of these stocks will come down a little bit. The pipeline infrastructures are down a lot now just in the last few weeks. But the natural gas focused stocks have been also weakened because of the 260, 270 MCF price. So the gassy names and the pipeline utilities will probably be first on the where you want to be putting your toes in the water or getting more names. And then the oily names, if the price backs off below 80, you'll get another chance to buy oily names at good prices again.
Uh, Let me ask about natural gas itself. I mean, we obviously know about the U.S. shipments to Germany. That was much ballyhooed, and it was an impressive sort of engineering feat to have that floating LNG plant, up and running so quickly. Especially as the Germans themselves said, I think it took them 20 years to build one of the major airports, and they got this thing done in about 10 months. But is that creating sort of a more international price for natural gas? The more we see that, we see the demand, we see contracts being signed left, right, and center by major buyers. I mean, locking in their LNG. But is that creating a more international price because obviously we've got higher LNG prices in Europe, natural gas prices, I should have said, in Europe than we do in North America?
Yeah, I think there's like 3 zone pricing. There's the European pricing, which is the highest around. Vermilion just put out a press release showing that, the price, today is like $22 US and
Yeah.
MCF, but they were selling hedging into 2024 at over $30 on MCF because people thought there'd be a big drawdown this winter. And so the storage build would take more and cost more. European prices would be the highest. Then just below that would be Asian prices. So prices going into markets in China and South Korea and Japan, they would probably be in the mid to high teens. And then you come back to North America, and then we have a locked in system here. And so prices here are the cheapest
Yeah.
relative to other places around the world.
Just quickly, obviously there was the big, sort of September 21, I think, in through last year, we call it an energy crisis, certain shortages, huge problems if you're in an emerging market, when you have the US dollar going up in conjunction with energy prices, it was a nightmare, Sri Lanka, Pakistan, et cetera. Then Europe comes in and tries to buy the gas they didn't have, pushing the prices up. Again, who can't afford that?
Yeah.
Developing nations. I mean, all of that. This is just asking for your take on it. And that is, did you see any lessons learned? I mean, I'm astounded when I read stuff coming out of Europe. It's like 2000, September 221 through 222 never happened.
Yeah, Europe, really didn't focus on natural gas, and they were trying to stop fossil fuel drilling in
Yeah.
France,
Yeah.
going into the Netherlands because of the earthquakes. They wanted to shut down the Groningen field, one of the biggest fields in Europe, because of that. And Germany was slower on allowing drilling. But LNG, as you said, they just it's like wartime. You make things happen, and you just make it happen, just like what happened in World War II, where the American economy turned to a war economy very quickly, and everything had to be built quickly, and the roadblocks of jurisdictions putting their 2 feet in there never happened. It was thrown away, saying this is in the best interests of the national effort to win the war. So I think that these countries in South America and in Africa are going to have to look for to drill up and find energy resources of their own, and that's why part of the company list that we cover are international names, companies that are working in Colombia, Brazil, Trinidad.
Yep.
In Asia, we have a company we cover that's offshore Thailand, and what we want to do is find more companies that are drilling internationally. Vermilion, of course, is drilling in Europe in a number of places, so that if they find the reserves, then they can be more self-sufficient and not need to import. But again, the rule of law has to be there. There's a lot of countries where despots are running in Africa, where of course, you don't want to put money in if you don't think you're going to get your returns out. And so, again, the rule of law is going to be an issue that we hope will be resolved in some of these jurisdictions that are going to be significant importers of energy in the years ahead.
Well, let me finish with this. You've got a major conference coming up in Calgary in October, and I mean, this is a chance for people to go face to face with the companies themselves. That's what's so unique about this. You don't have to read it; you can bring your questions right there directly. And I know, with Money Talks, we've got both Grant Longhurst and we've got Victor going over to help host the event. But tell me just a little bit more about it, like especially the focus. What will people walk away from your major conference?
Well, what we've done this year is we've expanded taken way more space, and we've got the Bella Hall, which we're going to start the plenary, and where I'll be doing my introduction speech. But introducing the conference opening will be our premier. Daniel Smith is coming to open the conference, so that's a new thing for us. Last year we had 34 companies between clean tech and the conventional. This year we're going to have 45, so a big increase in the
Yeah.
attendance there. But just giving you a couple examples. In the natural gas side, Tourmaline, Birchcliff, New Vista are coming. In the liquid side, Crescent Point, Strathcona, InPlay, and Surge. On the service side, STEP, Trican, and CES are coming in Essential. On the international E&P, we've got Alvo Petro, Canacol, Grand Tierra, Touchstone, Valura. And then the clean tech, we've got helium, copper, lithium, uranium companies. One of them, you may know the CEO, Drew Zimmerman, is the CEO of
Yes.
Stallion Discoveries, and he'll be there presenting the uranium upside that he has from his Saskatchewan assets. So and then the royalty, we have Source Rock Royalty and Topaz coming. So we really have a
Yeah.
wide variety. And the benefit is the sessions are 35 minutes, 25 minutes, the companies tell their story. Then the moderator hosts like Victor and Grant will have a 10-minute Q&A. But then we have booth rooms. So we have massive amounts of time broken up where people can go to the booths and spend time with the management, asking them additional questions, learning more about the stories, similar to what like you have at the World Outlook, where you have the booths there and companies can, and you spend time with attendees, and attendees can ask a lot of the questions they want. We have one other new thing this year. Step Energy, which is one of the energy service companies coming, is bringing 2 units. One of them a frac unit, so people can see what that's all about, and then a coil tubing control unit, so people can learn more about that. So
Wow.
we're going to have the first time of a show and tell of a product. So it just shows you that every year we try to find ways to make the conference bigger and better. Last year we had 560 attendees. This year we have capacity for over 800. So we're on the marketing campaign, and I gather you aren't Twisted Patty there.
Yeah, I was going to say I don't like this part. Hey, give me the dates once again though first before I tell the audience something. I hope you got your ears plugged. But what are the dates again?
It is one day, Saturday, October 14th at
Yep,
Mount Royal University in Calgary. People can, if they're from out of town, if they have friends, they can stay there. There's lots of hotels in the area, so people can just book on their favorite travel website to get themselves a hotel. The
great.
conference starts at 8 o'clock with breakfast, and we have sponsored breakfast and lunch, so people have food during the day, and it'll probably finish around 4:30 on that Saturday. So it's a full day. There's 5 presentation sessions, and we have 9 rooms, and one of them is the Money Talks room, as you mentioned, where Victor and Grant will be hosting that room on behalf of yourself and Money Talks.
Well, speaking of money talks, now this is the part we didn't check with you, but we talked with Patty about this. If you are a Money Talks listener, take advantage of this. That this is a terrific deal. If you subscribe for just the 3-month Schachter Energy Report, $249 for the quarter, great rate. No, better rate than that. We get you $100 off that rate plus 2 tickets. That's a huge value. I mean, we're talking the tickets are $299 each.
The early bird are 119, so
Oh, right,
238 right now. But then
238.
after September 15th, they go up to 179. So whatever it
Okay,
is,
sorry.
taking
Yeah,
the 149 for the first quarter and then going to the regular rate gives them the 2 tickets. So anyone who can come from anywhere in Western Canada to the event, and again on the, I think Grant has the list of all the companies that have signed up. You can see if you own any of them, and if you do, if you want FaceTime with it, if you went to buy a car, you'd want to go and see the car, read
yeah.
consumer reports, go and take a test drive. Come and do a test drive with the companies you own.
Well, we're going to put all that information up on the website too, and our social media, our emails, etc. But my point is, hey, Money Talks listeners, get $100 off. Take advantage of it, and we thank Patty for that, and you also, Joseph. But look, that's going to be a terrific event, October 14th. But in the meantime, I want to thank you for taking the time right now. Pivotal point, in the energy markets, people should pay attention. Thank you, Joseph.
My pleasure. Good to be with you again.